Good morning, ladies. My name is Yvonne, and I'm going to be the facilitator for this. You are here in the Financial Freedom Breakout Session. Today we have with us Yvonne Allmond. She's the Executive Vice President and Community Financial Engagement Officer for TowneBank. We have Ron. We have Ron Stowe. He's the Senior Mortgage Loan Officer for RW Towne Mortgage. Then we have Nirali Trovato. She's the Senior Vice President for Towne Wealth Management. So I'm just going to be in the back if you need anything, but we've got a great panel and they've got a lot of wisdom to impart.
Good morning, everyone. Can you hear me okay? Okay, great. We're going to all talk about financial freedom in our particular industries and how to get to financial freedom. For some people, what does financial freedom mean to you? It's like, I want to be a millionaire. I want to be a billionaire. Well, everybody can't be a millionaire or a billionaire. Some people are going to be just plain old us, but we still need to manage our money some kind of way. So one of the things that I usually like to talk about to start off with is, do you know where you stand financially? How many of you have heard of, how's your credit? You know what credit is? Yes. And credit is basically just your financial history. It's like a financial resume. So everybody should know where they stand financially with their credit. There's a website, www.annualcreditreport.com, that you can run. It used to be like annually that's why it was annual credit report. But over COVID, there was so much fraud that they allowed you to do it on a weekly basis so that you could check all 3 credit reporting agencies on a weekly basis. And when you do that with annualcreditreport.com, you will get a credit report from Equifax, which is typically what we tend to use here on the East Coast, Experian, which is the West Coast, and TransUnion, which is the Midwest. And all of those should be the same. If there's something squirrely on there, you should get a code that will tell you to go back to that organization. They will go to the organization for you. For instance, if you've got some Macy's accounts, you're like, I don't have an account with Macy's. And so instead of you going to Macy's, because they're going to transfer you all over the creation, you will never get to anybody who can help you. But you go back to them and say, I don't have an account with Macy's. They will go to Macy's. And if Macy's can't show that that was yours, then they will take it off. So you don't have to do that, but you just need to know where you stand. And to get your financial freedom, it's how can I do what I want to do and need to do for myself and my family financially? Money is going to be part of our lives no matter what. It can't be your whole life, but it's going to be part of your life. So you need to find out where you stand. If you have a bank account, how many people have a bank account? And how many people have a bank account in their own name? Okay, that's very good to have an account in your own name, except for Ron. But I bet you his wife has one in her own name, but she's just not telling him. But I always suggest that, when even couples come to me, that, you have an account in your name, you have an account in your name, in addition to a joint account, if you have an account, and you should put some money in your own account every time you get money. If I pay MasterCard or Visa, I also pay Yvonne. I've always done that. No matter how little or how much money I have made, even if it's $5, it's going into that account. So when you go to the bank to open up that account that's in your own name, make sure that you ask them for an account that has no fees, because you know that there are fees if you fall below a certain balance, but you need to ask the person who's opening your account, tell them. Very wealthy people, the first thing they say is, I don't want to pay any fees. I don't want to pay this. I don't want to pay that. I don't want to do this. And they don't. We're paying all the fees for everybody else. So if you fall below a certain balance, $20 is going to come out. That's $20 out of your money that you have saved over a couple of months. So you make sure you tell them that I don't want to pay these fees. So slowly you're building up your own finances, and you know where your finances are. Every day, you should check your account. Those of us, most of us, let's say most of us who work in the banking industry, we check our account every day, because a lot of the transactions are still done by hand. And so when human involvement is involved, there could be a mistake somewhere. So you make sure that every debit or transaction on your account is something that you know or that you're familiar with. An example, recently I made a $220 payment on a credit card. So I checked my account. So I saw from that credit card company, $20 was debited. So I said, wait a minute, I made a $220 payment. So I called them and they said they see where I tried to make a $220 payment, but they only debited $20 and they made an adjustment. If I hadn't called them, I would have been $200 short. I would have been past due. It would have gone on my credit report that I was late. And then the trouble starts there because they don't care if you're 1 day late, if you're late by $1, the damage is done at that point. So you always make sure that you make at least a minimum payment. But there, I let them know and they made an adjustment so that I could make it the next month and it would not be considered past due. But you're responsible for your own credit. And you think that, well, I don't have enough money to pay what I need to pay this month on this bill. But if they ask for a minimum, if they ask for $6, and I've had a credit card when I was younger and the minimum payment was $6 and I made the $6 payment. I wasn't past due and it did not hurt my credit. But if I had not paid that, and then the next month I said, well, I'm going to make $50, they're not impressed by that. The damage is done when you did not make that $6 payment. And that has a domino effect for everything you try to do. Once you continue to do that and your score keeps on dropping, then it will affect employment. A lot of employers run a credit report before they hire you. If your credit is not good, they will not hire you. You will not get that job. While you're working there, some companies will run a credit report on you. And I have worked at companies, usually financial institutions, where we've seen the person from HR walk through the door, walk to somebody's desk, and we never saw them again because their credit dropped. Something happened on their credit report while they were working there. So your credit is very, very important. So you watch your account every day, make sure you know where you stand, make sure that the debits and credits from your account are things that you did. If you have a spouse, a mate, or somebody, you all are all in love. And so you can use my debit card. No. Don't let them use your debit card because you are going to be responsible. And the bank is not going to hear, well, my boyfriend, my girlfriend, somebody, no, it's in your name. It's your responsibility. And your credit is the one that's going to be hurt. I have seen so many couples break up and let's say that one of the spouses did not have any credit in their name and the other spouse messed up a whole lot of things. But when you have something in your name and they will run credit on you, then it helps that you have something in your own name. If everything is joint, then there could be some issues there. So just make sure that you know what your name is on. And I have seen situations where the spouse has put the other spouse on credit that they did not know about. So you need to find out everything that is on your name, especially when people have a house. I have seen people who have had a second mortgage taken out on their house by one of the spouses. And that's legally, you cannot do that, but it just creates a mess. By the time you get that all straightened out, you are really kind of in a little bit of a funk. So you really need to make sure that you know where you stand and create a budget for yourself. You see, we have a budget plan up there and all of you have 2 sheets. One is a spending plan and one is a budget plan. And so a lot of people wonder, where do I start? You should write it down. And sometimes in your mind, I know I need to pay this bill, I need to pay that bill. Write it down. You will be surprised at how much junk you are spending money on. So the spending plan, the budget plan this one that is completed up there shows take home for $40,000 a year. That's $2,400 a month. That's
Blake, do you want a completed one?
Yeah, $2,400 a month. That's not a lot of money. So on that form, you will see where with $40,000 a year or $2,400 a month, these are the expenses that you can do for $2,400 a month. But you put your own take-home pay there monthly and give one of these sheets to everyone in your family, your kids who think that money grows on you, and this is where money comes from. Let them figure out what money they have coming in if they have an allowance, and then what their expenses are. And then if they come up with all of these, I need the new iPhone 15, 16, 17, whatever. I just turned in my iPhone 8 because the bank said I was a security risk. So, so I upgraded. I couldn't get into the Wi-Fi. They said, oh yeah, that's a security risk. So anyway, so I upgraded to a 13. That's not high. They said, well, this is better than you have. So I'm in now. I'm good. But those things cost a lot of money. So if that child has, I need this and it's like $2,000, well, where's that $2,000 going to come from? And they need to know. So you can start them off with that to create their own budget on a monthly basis, and for your own budget to see how much money that you're spending, because sometimes it's this frivolous spending. How many times do you eat out when you have plenty of food at home? Okay. Every week, right? So for a week, keep a track of every single dime that you spend, every single dime. And at the end of the week, you're going to be very disappointed in yourself to see how much money you have wasted. But on these spending plans, and the other one is an actual spending plan where you can take the information if you, let's say, are a couple or even by yourself. But it actually calculates the taxes and everything. So the spending plan is a little bit different than the monthly budget, and you can transfer that over. And that separates your wants from your needs. I mean, I know that somebody was in there from Cox Cable, but how many Cox premium channels do you really need? So,
Still nothing to watch. Still nothing to watch.
I'm sure there are plenty of them if we got the right plan. But is that a want or a need? And a need is something that if you don't make that payment, there are consequences. If you don't pay your rent, if you don't pay your mortgage, there are going to be consequences to that. But a need, if Cox shuts you off, it's not going to kill you. It's not going to kill you at all. But, and another thing that we're talking about here, we're going to be talking, we only have a few minutes each, but you get the idea. Keep track of what you have. Know what you have. Always know where you stand. Those of us at the bank, we know how much money we have at all times. Most of us do know how much money we have at all times. So make sure that you keep track of your money. These days, if you're renting, or even if you have your own home, rents are going up and the landlords are not necessarily keeping up the property, and you're paying as much money as you could pay to have a mortgage. And part of your financial freedom is where you stand. You get confidence when you have your own account, your own money. Nobody can really kind of boss you around. I mean, you have your own money. It gives you that cushion. It gives you confidence when you know where you stand and you have your own money. So everybody should always have their own money. But then a roof over your head. So we're going to go on to Ron, who is going to tell you about having that roof over your head. And as part of financial freedom, do you rent or do you buy? And one of the statistics, don't want to steal his thunder, but I understand that 51% of all homes are purchased by single women. And that's a big statistic. So you may want to live at the ocean front. Everybody's like, I want a house at the ocean front. Well, so do I. But you may not want to start there. You can live where you live and live quite comfortably, and you could move up to that. But having your own home, I mean, when I got my own home and wanted to put something on the wall, I said, I can paint this whatever I want. I mean, I can put whatever I want on the walls, and it just gives you this confidence. So I don't want to steal Ron's thunder, but go right into it, Ron.
Okay, thank you. Hey, good morning. I'm Ron Stowe at RW Towne Mortgage, and I'm glad to have been invited. May I stand?
Yes.
Okay. Gotcha. Glad to be invited to be on the panel and to be here talking to you at my alma mater.
Yeah. You want your mic?
I want the mic. Okay, I'll take my mic. And so it's funny. I come in here. It's been a little while, and
There's better.
so when I was here, we did not have a Starbucks. But we had a bar. It's a Rathskeller. Anybody remember the Rathskeller? See, there you go. So, I mean, things are different. Okay. But anyway, thank you, Yvonne, and Nirali for being on the panel with us, and hopefully you'll get some good information on it. I have my boss here, Sarah Steadfast. Where are you, Sarah? She ran, she left. There she is. So my boss is here making sure that I'm supposed to be. And no,
Don't mess this up.
I do not have any accounts with my name only. And my wife owns several homes and she's not liable for any of them. I don't know how this happened. So
She was in my class.
she was in her class. There you go. So we're going to talk briefly about home ownership, and I figure I can show you better than I can tell you. And one of the myths that we hear right now is I should wait to buy a house. Anybody ever heard that? Rates are too high. I should wait to buy a house. And in some cases, that could be the right thing to do. But oftentimes, and as Nirali will tell you, money at work over a long period of time is how wealth is built. And that goes with your home ownership. And anybody can tell me what the interest rate on rent is? It's 100%. Okay, it's like there's no return. It costs you money to rent, really. So even though rates are higher than what we would like, we've been hoping and praying that they will come back down. They haven't yet. It's still best to get in the market the sooner the better. The sooner the better. So this is a quick example here, buy versus rent. It's a $300,000 house. And so if you're buying a $100,000 house, divide by 3. If you're buying a $600,000 house, multiply by 2. So but basically I just did 300,000. And what it talks about is the cost of waiting. The cost of waiting, even though interest rates are 7.5% in some cases. So in this example, what we find is that usually the break-even point is about the 3-year mark as far as somebody purchasing a house. You have out of pocket expenses, down payment, closing costs, things of that nature, and that's a pretty high barrier to entry. But then you throw on top of that, hey, the interest rate is too high, so you don't want to do that. So what we have here is this person 9 years from now will have over $95,000 in appreciation gain, and then an additional $36,000 in amortization gain. So do the quick math on that. That's almost what, $140,000 ahead of the game in 9 years. In 9 years, we have to have a place to live. We're either going to rent or we're going to pay a mortgage. Or if you got cash, you can buy cash. And Nirali will probably argue with you, don't buy a house cash. But she can do better for you, I'm sure. But the key is this person 9 years from now is going to be $140,000 ahead of the game. Whereas if you rented for 9 years, what do you have to show for it? You don't have anything to show for it. You don't have the $140,000. Don't have tax benefits. Don't have this is the wealth that we're rolling to our future generations. You know, buy this house, live in it for 3, 4, 5 years, and go buy a next one, something like that. That's the way I recommend that you that you think. Yvonne was right. The majority of home buyers right now are women. Okay, stable jobs, credit, savings. So you guys are out there doing it, and I just don't want you to take advantage or be taken advantage of because somebody's telling you, hey, interest rates are too high. Has anybody ever purchased a home where the interest rate was above 8%? Okay. Your first house. If you don't mind me asking, I don't want to put you on Front Street, but what interest rate did you have on your first house? 12.5%, and you were probably glad to get it. In the 80s, you're glad to get it. Okay. I bought my first house. Well, Regina bought her first house at it was 9.5%, and I played points to get it down. So, interest rates are relative. Now we have to keep in mind that then houses were maybe under 100,000, so on and so forth. So the appreciation of house is the other thing that we have to keep in mind. 1 year, That person that says, hey, I don't want to buy right now because interest rates are down and I think interest rates will be less in 1 year. So let's wait for 1 year, okay? Housing appreciation is appreciating about 3 to 5% a year right now, easily, okay? There's more people out there looking for houses than there are houses available. So there's competition. Is anybody shopping for a home right now? Okay, so shopping for a home right now. So should you wait? Well, if you wait a year, this $300,000 house next year is going to be how much? 310, 315. Okay, so interest rates are now instead of 7.5, they're 6.5. Guess what the payment is on a 6.5% house at now you got to buy it at 315,000. It's the same if you bought it at 300,000 at the 7.5%. But here's the difference. You don't have the $15,000 worth of the equity and appreciation. So it's really cost you more to wait. So it really costs money to wait. Now's the time. Here's a better example of that gain right there. So the forecast is buy sooner than later and put that money to work. The other thing we have is does anybody have any questions so far? Okay. And no, I never went into the Raskeller at all when we had the bar. We never went in there. Every Friday. We were there every Friday. Anyway, so a couple of things I'd like to mention that Yvonne mentioned. She talked a lot, and so it should have been about credit. Credit. Credit is important. One of the myths that we see about credit is that someone has to have perfect credit to buy a house. Now, if you do have perfect credit, are we okay with that, Sarah? See, she nodded her yes. If you have perfect credit, you nod your head yes, okay? But guess what? You don't have to have perfect credit to buy a house. You need about a 620 score. We have a table that I'm going to put some stuff out for first-time home buyers and things of that nature. Virginia Housing has a programs where at 620 scores, you can have home ownership, down payment assistance, that kind of stuff. Now, a 620 score, great. It's not obviously fantastic, but it's good enough to get in the house. And guess what happens once you buy a house with a 620 score? What's your credit score going to do? It's going to go up. I hear it all the time. Somebody say, hey, I'm waiting to get to a 720 score to buy a house. Yes, I hear it. I hear it. So there's two kinds of people that worry about credit. Those that worry about credit and shouldn't, and those that don't worry about credit and should. Okay. Okay. So you got a 620, go ahead and buy that house, get in there, and your credit score will jump tremendously right from there. So get in as soon as you can. Another myth, 20% down payment. 20% down payment. Any veterans in here? Okay. Navy? All right. Okay, so first of all, we are certainly not going to talk about the Army here. Okay. As being an Old Dominion graduate and commissioned right here in Navy, no, thank you for your service, ma'am. But for you veterans, it's zero down, take advantage of that loan as many times as possible, simultaneously, as many times as possible. If you're not a veteran, we don't need 20% down. We can get you in for 3 to 3.5% down, and you may not need that money out of your pocket, down payment assistance, grants, those sort of things. There's a way to get in the house. Some of that stuff's income restricted, but get in as soon as possible. It never hurts to save money. It never hurts to have great credit. Yes, ma'am.
You mentioned first-time home buyer. What exactly does that mean? Does that mean that you've never owned a home before, or what?
There's a reason why Yvonne's running the show here. Okay, there are reasons. So she asked the question: is there a reason? What's the definition of first-time home buyer? Does it mean you've never owned a home before? And it's not the case. A first-time home buyer means that you haven't owned a home within 3 years. Okay, guess what? A first-time home buyer can be somebody that was recently divorced. Divorce, you no longer own a home. You're a first-time home buyer again. Gotcha. Some of these first-time home buyer programs, you could own a house in California and haven't lived in it for a year or for over a year. Now you're still a first-time home buyer here. Okay. So first-time home buyer is a very strong qualification to get you in some houses. Please don't Google and Bing it. Okay. Because Google and Bing is my #1 competition. #1. Google something and I got the answer. No, you don't. Talk to a professional, Nirali, Yvonne, myself, and we'll give you the right information. But thank you. We already talked about renting is not cheaper. Oh, this is a good one. The lowest interest rate is the best interest rate. Have you heard that before? That's okay. We're not shopping for cars. We're not buying a motorcycle, and we love to have a jet ski. Those things, yeah, you can argue interest rates the best thing, but the lowest interest rate in a mortgage is not necessarily the best one because it could come with more costs. Okay, that person at the water cooler at work that's trying to impress you, saying they've got a 3% interest rate. They didn't tell you they paid $90,000 to get it. Okay, it didn't make any sense. So make sure you're talking to your professionals, your realtors, your lenders, your advisors to get the best interest rate that's good for your circumstance. Okay, and the other thing is, and I'll be finished up here, is buy a home, and you get a first-time home buyer program. You buy a house. Do you have to live in it for the rest of your life? Okay. If there are any realtors out here, they struggle with this because somebody's trying to buy that house and it's the house that they see on HGTV. Okay. We're probably not going to get the HGTV house, the first one. Many of us own houses. We still don't have the HGTV house yet. So, but you can buy that house, live in it for 2 or 3 years, rent it out and go buy another one. That's really how a lot of wealth is created, the slow drag. Live in that house for 2-3 years, and then buy another house. I can show you a way, especially these veterans out here. You can have 4 houses in 10 years and have very little money out of pocket. So, we're doing questions later on.
We are going to do questions later on, but I have one more thing. A lot of people say, go apply for a mortgage. How do you do that?
Apply for a mortgage. Okay. So applying for a mortgage, there's many ways to do it. So typically speaking, if you're doing the traditional way, work with a realtor and stuff, the realtor may refer you to somebody, local bank or something like that. We have TowneBank, the premier community bank in the area. We are certainly lenders that are willing to be of help. But know who you're talking about, know who you're talking to, and buying a house is all about being local. So I work with people all the time, Virginia Housing and military moving to California. They say, hey, can you do a loan for me in California? No, I'm not licensed in California, nor would I want to, because there's something going on in California that I may not know about. Okay. But I can talk to you all day. I just helped a young lady just today. She's moving in from Pittsburgh and her brother does loans in Pittsburgh. But guess what? He can't do the Virginia Housing Down Payment Assistance Program. So find a local lender that you trust. Get the information, and you can apply online or in person or over the phone, and we help people all day long.
And you get pre-qualified before looking for the house.
You definitely get
See the house
pre-qualified
of your
before looking.
dream and you can't afford it. So get pre-qualified and look in your range.
Absolutely. And it's no cost, no obligation for you to get pre-qual. Nobody should charge you money for a pre-qual. And we particularly have a second opinion program where we give a $100 gift card. Sarah keeps the gift cards. She won't give them to me. I've asked for them for years and she won't let me hold them. She may have some now. I'm just joking, but thank you kindly and appreciate your time.
So now Nirali is going to talk to us on investments and wealth management. And I know if you've got $10 million, you already have a person, but a lot of us don't have $10 million. So what do we do?
Sure. Well, first, I wanted to explain what a financial advisor is, because before I started in the industry, I had no concept of what all that entails. Does that mean they're looking at my investments? Does that mean I go to them for advice? What is it that person's doing?
Can everybody hear her?
Yeah.
Okay, good.
Okay. Sorry, I've got this weird echo thing going in my ear, so I want to make sure you all can hear me. So when a client comes to us, the first meeting is generally driven by some sort of major life event. So they're going to come to us because they're approaching retirement, or their child's going to go to college in 3 years and they're like, how am I going to afford this? Maybe they have an inheritance and they just received an inheritance. So it's some sort of major milestone that they come to us with. And when they come to us and sit down in that first meeting, we're trying to gather all the facts. I want to know about your financial your financial picture, but I also want to know about your family dynamics. What about your ex-wife? Tell me everything. And I want to learn everything there is, and your goals, not just what you came to me for, but also what do you want your family to look like in 20 years? I want to learn all of that, because all of that feeds in to what advice I give you. And so, and I can't just isolate the one issue that someone comes to me with. And so if it's just retirement, I can't just, if someone walks in the door and says, I've got $10 million, do I have enough to retire? Well, you and me are going to be like, gosh, I hope so. But if that person's spending $1 million a year, they may not have enough to retire. And so I need to understand all of the facts when I'm giving advice. So we're going to spend a lot of time listening and asking questions. And then all of that leads to step 2, which is the other part of financial advising, which is investing the funds. It's the how. So you've got these goals. We want to reach them. How can I help you get there? And all of that starts with asset allocation. And what that means is it's a mix of how many stocks and bonds we're going to hold, how aggressive we can be. And I want to make sure that fits with your comfort level. I want to make sure you could sleep at night, but also it needs to be able to grow enough for you to be able to reach all those goals we just talked about. And so it's a balance. It's a part art, part science. And that's why I love that part. I specifically work with multi-generational families, high net worth individuals, and then business owners that are going through business transactions. And that's where my expertise really lies. But there's so many advisors out there, and you don't have to go through these things alone. You can call someone at Towne Wealth, and there's going to be someone that's a good fit for you. And I'm happy to be that person to guide you in that direction. I'm going to spend a lot of time talking about some of the questions that I get asked the most. I'm at the bar, and I'm not at the bar right now, I'm pregnant. but 6 at the Rathskeller. I was there, let's say 6 months ago. And someone will come up to me and say, you're a financial advisor, right? Well, what's the best way for me to pay off my debt? I've got the student loan, I've got this credit card. How do I pay it all off? And so the way I try to look at it is step 1, look at your budget. Look at what you're bringing in every month. Look at the sheet that you've put together with Yvonne, and look at what is discretionary income? What is the money that's left behind, and what can you allocate to debt? So you can say, and in case of an emergency, you can always dip into that, but not for that handbag that you want, not for the shoes. You have to stay disciplined. And so if you have, $500 every paycheck or every month that you're going to allocate towards debt, make sure you do that every month. And step 2 is ordering all your debt. What is costing you the most? Oftentimes that's going to be your credit cards, your student loans. It's not going to be your mortgages or your auto loans. And so you want to make sure you're paying down what's costing you the most, because everyone in here, either from experience or has seen someone close to them where debt, it starts to snowball, and that costly debt, it snowballs fast, and you can't get ahead of it. And you don't want to be caught behind that snowball. You want to get ahead of it and start chipping away. So it might be a big loan or a big credit card, and you're intimidated by paying it off because you're like, is my $50 a month really making a difference? It is, because you're not paying 25% on it. So make sure you try to get ahead of that. Also at a bar, people come over and say, well, how much do I need to have to invest? When do I start investing? Especially during the pandemic, Robinhood's out there. Everyone is a financial advisor everywhere you go. Social media, everyone on Instagram is posting pictures about, crypto and all of that. And so what do you need to have to start investing? Well, there's different buckets to saving. The first bucket I'd say is your emergency fund. So what happens if you get in an accident, or what happens if you get laid off in this economy? Do you have enough to be able to pay all your expenses? And so if you're the sole income earner, then you need to make sure you have at least 6 months of expenses on hand. That needs to be your priority, is filling that bucket. If your partner is also earning an income and you have 2 incomes coming into a home, you might just need 3 months, because you can fall back on your partner to pick up the slack, hopefully. If not, you need to find a new partner. And so that's sort of the starting point. Simultaneously, you could start filling bucket number 2, which is your retirement. And so if your employer is offering a retirement plan, and if they have a match, oftentimes they say, hey, you contribute 6% of your compensation into the retirement plan and we'll match 3%. That's free money. There's no reason to pass up on that. So if you can, put as much money as you can into that bucket and start saving. That'll help you get ahead. And the sooner you start that, the longer it has to grow. And that's the cheapest option that's out there. You could hire me. I'd love for you to hire me, but I'm a little more expensive than your retirement plan. So that's a good place to start. Get your feet wet, learn investments, learn how you feel when the market goes up and down. Some people put money away. They never log in to check it. They don't care. Other people, they're waking up every morning, refresh. Can I retire today? And so you have to get a sense that that's how you get your feet wet. You can, in your retirement plan, you can put up to $22,500 away. If you're above 50, you could put away 30,000. So we might not be there yet, but once you get there, you might have some accumulating savings in your checking account. And that's the money that can be invested longer term. But you want to start maximizing those other buckets first. Also with the retirement plan, if you're not, and Kelly, my partner, reminded me of this morning on the drive in, you might not be the income earner. You might be home with the kids. Your partner might be out there making a salary. They have exposure to a retirement plan. You can still contribute to an IRA. Don't forget yourself. Just because you're at home doesn't mean you can't have an account in your own name and put money in it. And your partner should want to empower you to do that. You got to harness that power. And so those are, the 3 buckets that I encourage you. When you get to that accumulation phase, you might want to talk to a financial advisor, because at that point you've got substantial wealth and you need advice on what to do with the rest. Should I be paying down my mortgage or refinancing my mortgage? There's other things we need to be thinking about as well. And then I know Yvonne and I, go ahead.
Question. I have heard that if you want to invest in the stock market, because maybe you inherited like $10,000 or $15,000, but I have heard that if you don't have $10,000 or $15,000 to lose, that you should not invest in the stock market with that money.
Well, the number, the actual threshold varies from person to person, because 15,000 might be a weekend away for some people and 15,000 might be life-changing for others. And so it needs to be a substantial amount, but it's going to be a market risk. So it could be 2020 where we wake up one day, the whole economy shut down and the market's plummeting quick. And if you're going to need that money during that time and you're going to have to take it out at the bottom of the market when now your 15,000 is 8,000, then you don't need to put it at market risk. And so it needs to be a longer term investment. When you get into the market, you're exposed to the ups and downs of the market. And so you want to make sure that money can actually be out there until the market recovers, and then you can pull it out at that point. Yes, ma'am.
How about annuity with something like that?
Annuities serve a purpose for a lot of people. And so what annuities are, for those of you that don't know, is you pay in possibly a single premium, or you pay in over a period of time, and they'll pay you income in retirement. That is a wonderful tool for retirees, often because you're dependent on this income. You need this income to pay bills. And so this flow of income is going to come in. Oftentimes it's a fixed amount. Sometimes it's variable with the market. If you're not disciplined with saving, it's a really good option because you've put that money away already and you're going to get an X amount in the future. Annuities, I will say, sometimes can be expensive. And also they don't fit everyone's picture. And so you may be able to earn more somewhere else. So it's person to person, but it's definitely something, that's a great tool to have. And if you know yourself and your advisor gets to know you, they'll be able to tell you whether it's a good fit or not. And then, do you have? Oh, yeah. Oh. Yeah, I'm going to do one last question or one last I think you asked me this, but what are some mistakes that people often make, and primarily women, in finances? And so I think the biggest mistake is probably not prioritizing your finances. And I know that this sound like when you go to the dentist, you leave and you're like, my teeth are the most important thing in the world. I need to go buy that hydro pick. And that's how it is for me, is when you leave my office, I want you to think I need to prioritize my finances. But really the decisions you make today affect you and possibly generations to come. And so the sooner you start, the better it is for you. Oftentimes clients come to me and they're right up against retirement or about to send their kids to college. Well, at that point, I'm looking at an autopsy and I'm trying to help you. And so what I want to do is help you get to that point, and start saving. And so the sooner you start, no matter how small, you have a better chance in retirement, because this is really going to affect you. And so it's something that's hard to prioritize. I know life is busy, but it's something you need to prioritize for your future self. And then a mistake that women primarily make is saying, my partner's going to take, and I know we all have a lot on our plates. We're thinking about dinner, we're thinking about groceries. So we're like, if he or she is going to take this, take it. But we need to be involved in the finances. You know, we live on average 5.7 years longer than men. And so at some point you are going to be responsible for your finances, and you need to understand what those look like. And it's never too late. We've had clients in their mid-80s. The husband came in with the wife and he's done finances his entire life, their entire relationship. And he came in and said, you know, I'm getting older and I really want to empower my wife to start taking this on. So over the next 2 years, she and I worked together. He and she worked together. They got to know their finances. And then when it came time for him to really focus on his health and well-being, she had already been empowered to take it over. And now she runs all of the finances. And that's something I love being a part of, but I wish that most couples started earlier. And two minds are better than one. So if you're talking with your partner and you're bouncing things off of one another, you're more likely to make prudent decisions than not. All right.
You gave us the 5-minute
Yep.
signals. Are there any questions? And she was talking about the person who are in their 80s. When I started doing this, my mom was in her 40s and I saw that she really didn't care. So I started her back then in her 40s. So she was good.
Here's a question there.
So for someone who is not seeing the tax benefits, what are they doing wrong possibly
What do you mean
on
seeing?
the mortgage?
Oh,
So I'm not a tax advisor, nor do I spend the night at Holiday Inn Express last night. So they did change the rules when it came to some of the mortgages where the standard deductions and stuff really kind of outstrip the mortgages. If you've got a low interest rate mortgage, you may not be able to deduct your taxes off of that. But in the long run, if you look at, you're on this grid here, you're going to be better off. We should be, the tax advantages that was additional tax advantage to buy a house, but now it's not necessarily there. But on the wealth side, it's still going to be a good idea. What do you think?
I think it's also important to have an accountant or some sort of professional help, because oftentimes we rely on TurboTax because it's the cheapest option. And I'm guilty, fully guilty. But we might not understand enough to help ourselves there. And so sometimes it's worth spending the extra couple $100 to make sure going forward, we're filing our returns correctly. And so sometimes it is worth paying a little extra to have a professional help you, because it's hard to know all the laws and keep up with it. And that's what our job is. That's what a CPA's job is. And so it might be worth your while if you're not seeing that impact.
I used to do taxes even for H&R Block and did TurboTax myself one year, and they don't ask all the questions. So I stopped doing TurboTax that first year. She had a question.
Yeah, so can you clarify, Ron, for the refinancing piece? I've been told a few things and I'm not sure which one to go with. So you refinance to get a better mortgage rate and then you end up paying more on the far end of it?
Potentially. So there's a number of reasons folks refinance. It's individual reason. Sometimes the lower payment, sometimes debt consolidation. Refinance, anytime you restructure stuff financially, is going to cost some money. So with your financial advisor, talking to your lender, stuff like that, you have to make sure that whatever you're doing, the reason like you're refinancing in the long term, it makes sense. So.
There was a question.
Yes.
How do you go about finding a financial advisor that's not gonna break your pocket or?
Well, that's tough. But sometimes you'll find that if you just make that call, for instance, if I have a client that calls me that's not a good fit, I'll at least guide you in the right direction. If a lot of calls I get, I'll sit down and I want to make sure it's a good fit because that's good for me. If that way the client's happy, and then it's a good fit for you because you're not going to get anything out of it if I'm not the right person. And so I'll spend that first meeting or that first phone conversation with the client and try to get to know what their needs are. It might be that you just need to talk to Yvonne that can direct you to someone in town specifically because you're really narrowed in, focused on a specific financial part of your life. But oftentimes people will be more helpful just to guide you in the right direction. But you just got to pick up the phone and call to get those resources.
And somebody that you're comfortable with.
Okay.
Okay, sorry.
I know that several of you had your hands, please, they'll be here for a couple minutes after.
Mhm.
I do want to give them a gift on behalf of the Senator and ODU. And let's please give them a round of applause.